Hello, I'm Eli Schragenheim. Together with Marris Consulting, I'm going to deliver October 15-16 a workshop that to my mind is essential for the managers, executives of any sort of organization. And this is because the topic is about the most critical decision making that every single organization has to make, and to make it continuously all the time. The first type of such kind of decision is regarding what do we sell to our clients. Every organization sells to clients a variety of products and services and is always under the conflict to increase the variety, to add more product, to take out some products, to have some special prices for a certain market segment, etc. Quite a lot of decisions. The second, well-related topic is the pricing. What price will be good enough for quite a large enough number of clients that eventually will bring us profit? This is a very critical question. And the third category, again related to the other two, is how much capacity the organization needs to maintain. In other words, how many products, quantity of product, is the organization able to deliver to its clients, and how much capacity it should maintain. A very critical area of decision. Now, the current tools for making those decisions are all based on the convention of management accounting, in which the main tool is something called cost per unit. And fellows, my own professor of accounting have told me back in '76 that this is a flawed concept. However, this is a concept that we have. There is nothing else. Really? Goldwert made himself very famous back in '83 when he announced cost accounting is enemy number one of productivity. And right he was. He could prove the point. Well, we need, I think even now, much better to understand how come that quite clever people from management accounting are still sticking to something that they know is very far from being perfect, and they know that in too many times it truly misleads a decision maker to take the wrong decision about these type of decisions. How come? I think I have an answer. More than that, I think I've took the original ideas of Eli Goldwert and complement them with something that makes the whole concept much more robust. And right now, I mean, the main decision is, or the main thing that is on the table is when there is a new decision, how do we making our mind whether it's good or not? Because eventually we don't need the per unit kind of support. The key question is still the one: if we have something on the table, like a contract with a large client for a reduced price, but for a committed large quantity, will it increase our bottom line or it will decrease it? Because in order to answer this question, we need to go into the financials and we need to go into the available capacity profile, and we need to take into account whether we can increase capacity, for instance, by overtime or outsourcing, or what. The process I've come with is a mutual decision process where sales, operations, and finance are coming together, each one with his own perspective of the problem, his own intuition, his own extra knowledge about what is on the table, and some kind of calculations that the computer can do very quickly that will let us check various what-if scenarios. The whole process of decision making takes into account both intuition and calculation in order to check the overall ramification of every decision, including the uncertainty that exists in almost every decision. Please don't tell me that this is not important to your business, because it definitely is. And if you like to see whether I do have an answer to all your questions about it, come to my workshop October 15-16 in Paris.